Ever wondered why financial pundits talk about bulls and bears when discussing the stock market? Well, let's unravel this mystery together. When we talk about the stock market, these two animals become incredibly significant. Imagine a bull charging ahead, horns thrusting upwards. This symbolizes a bull market, a term used when everything in the economy is just right. Jobs are plentiful, gross domestic product, GDP, is growing, and stocks are rising. It's a time of optimism, when investors are confident and expect future market prices to rise. On the other hand, picture a bear swiping down with its powerful claws. This represents a bear market, when the economy slows down, unemployment rises, and stocks drop in value. It's a time of pessimism, where investors are cautious and expect the market to decline further. Now, don't be fooled into thinking that these are just random animal choices. The imagery behind these terms is quite insightful. You see, a bull strikes by thrusting its horns upwards, indicating a rising market. Conversely, a bear attacks by swiping its claws downwards, symbolizing falling prices. These terms also help investors gauge the market sentiment, a crucial aspect in making informed investment decisions. In a bull market, the optimism and high investor confidence can lead to widespread buying, fueling the upward trend. On the contrary, in a bear market, the widespread pessimism and low investor confidence can lead to selling, pushing prices down. However, remember, nothing lasts forever. Markets are cyclical and they fluctuate between bull and bear periods. The key is to stay informed and make strategic decisions based on current market conditions. So, next time you hear bull or bear, you'll know exactly what they're talking about. You'll understand that they're not discussing wildlife, but the state of the market. And knowing the difference between the two can help you navigate the financial wilderness with a little more confidence. Now let's uncover the meaning behind dividends and PE ratios. Picture yourself at a bustling fruit market. You buy a fruit stand, not just for the delicious apples it sells today, but for all the apples it could sell in the future. In the world of investing, these apples are the company's profits. And as an investor, you're entitled to a portion of these profits. This portion is what we call dividends. It's like the company is saying thank you for believing in its future apple sales. Now, imagine you have two fruit stands to choose from. They both sell apples, but one stand is selling at a higher price than the other. How do you decide which stand is a better deal? This is where the PE ratio, or price to earnings ratio, comes in handy. The PE ratio is a simple tool to help you compare the price you're paying for each apple, or in investing terms, each dollar of a company's earnings. A lower PE ratio could indicate that you're getting more earnings for your money, while a higher PE ratio might mean you're paying a premium for future growth. However, it's important to remember that like any tool, the PE ratio isn't perfect. It doesn't consider factors like debt or future growth plans. It's just one piece of the puzzle in your investment decision. Also, not all companies distribute dividends. Some prefer to reinvest their profits back into the business for future growth. As an investor, it's up to you to decide whether you prefer the immediate gratification of dividends or the potential of future growth. In the end, understanding dividends and PE ratios can give you a better grasp of your investments. It's like knowing how to pick the best apples at the market. With these terms in your vocabulary, you're already ahead of many beginners. In today's digital age, trading has never been more accessible. Gone are the days when investing was a playground only for Wall Street gurus and high-flying financiers. Thanks to the internet, the world of stocks, bonds, and ETFs is now at everyone's fingertips. Enter the realm of online trading platforms. These are essentially digital marketplaces where buyers and sellers can trade securities such as stocks and bonds. Think of them like an Amazon or eBay, but for investments. Prominent among these platforms are Robinhood and TD Ameritrade. These platforms have democratized investing by bringing Wall Street to Main Street, making it possible for virtually anyone to participate in the stock market. Robinhood, with its mission to democratize finance for all, allows users to buy and sell stocks, ETFs, options, and even cryptocurrencies without commission fees. Its user-friendly interface and gamified approach has attracted a new generation of investors, especially millennials and Gen Zs. On the other hand, TD Ameritrade offers a more comprehensive platform, with a wide range of investment options, research tools, and educational resources. It caters to both novice investors looking to dip their toes in the investing pool, and seasoned traders seeking advanced strategies and analytics. But remember, while these platforms have made investing more accessible, they also come with their own set of risks. It's crucial to do your own research, understand your risk tolerance, and invest wisely. And remember, investing isn't about getting rich quick, it's about building wealth over time. So whether you're looking to grow your retirement savings, save for a down payment on a house, or simply want to learn more about the stock market, online trading platforms can be a valuable tool in your financial arsenal. And the best part? You don't need a fancy finance degree or a suit and tie to start investing. All you need is an internet connection, some initial capital, and a willingness to learn. So, with just a few taps, you could be making your first trade. But hold on, it's not all smooth sailing in the stock market. Despite the potential for substantial returns, the stock market is not without its risks. It's like a roller coaster ride full of thrilling ups and downs. The stock market's unpredictability is known as market volatility, and it's a fundamental aspect of investing. It's like stepping into a boxing ring. You never know when the next punch might come, but you prepare for it anyway. Market volatility is driven by various factors, including economic indicators, geopolitical events, and even investor sentiment. For example, a sudden change in government policy or the announcement of a company's earnings can send the stock market into a frenzy, causing prices to fluctuate wildly. Another risk inherent in the stock market is the possibility of an economic downturn. When the economy takes a nosedive, often due to factors beyond our control, it can cause a ripple effect in the stock market. During the Great Recession of 2008, for instance, many companies saw their stock prices plummet, leading to significant losses for investors. However, it's essential to remember that these downturns are part of the market's natural cycle. Like the changing seasons, the stock market experiences periods of growth and contraction. It's all about weathering the storm and staying the course. But let's not forget about individual company risks. These are the risks associated with investing in a particular company. If a company underperforms or goes bankrupt, the value of your investment can decrease significantly or even become worthless. So yes, the stock market can be a risky game to play, but remember, every cloud has a silver lining. These risks also create opportunities for savvy investors who know how to read the market's ebbs and flows. But don't let these risks scare you. Knowledge is your strongest weapon. The more informed you are about the stock market's inner workings, the better equipped you'll be to navigate its choppy waters and come out on top. So, keep learning, stay informed, and remember, fortune favors the bold. And that brings us to the end of our journey today. We've traversed the wild terrain of the stock market together, decoding the cryptic terminology that once seemed so daunting. We've learned that a bull market charges forward with optimism and growth, while a bear market swipes downwards, marked by pessimism and falling prices. We've also unraveled the mystery of dividends, those delightful cherries on top of our investment sundae, and the PE ratio, our trusted guide to understanding the value of a company's earnings. And let's not forget our exploration of online trading platforms, the digital gateways to the world of stocks, making trading as simple as a few taps on your smartphone. But remember, my fellow investors, while the stock market is a land of endless opportunities, it's also a terrain fraught with risks and uncertainties. Market volatility and economic downturns can throw even the most seasoned investors off balance. Yet, fear not. Knowledge is your strongest ally in this journey. Staying informed and understanding the market trends can help you navigate these turbulent waters with confidence and poise. And always remember, investing is a marathon, not a sprint. It's about patience, persistence, and a long-term vision. So keep learning, keep growing, and never stop chasing your financial dreams. The world of investing is vast and thrilling, filled with endless possibilities for those bold enough to step into it. Don't forget to show some love by liking, commenting, and sharing this video. Your support fuels our mission to demystify the world of finance and investing, one video at a time. And if you haven't done so already, do subscribe to ProsperFin TV for more insightful content, and hit that notification bell to stay updated on all our latest releases. Until next time, keep those investing spirits high, and remember, every financial journey begins with a single step. Happy investing.